Since it was launched in May of 2020, Jepi is an ETF that's grown to become the largest covered call fund by assets under management. According to their website, Jepi has amassed over $40 billion worth of investors' money, and during certain months actually saw some of the largest inflows of any publicly listed ETF. For instance, in January of 2023, they recorded over $2 billion worth of inflows, which placed them in the top 10 among all ETF inflows during that month. Overall, Jepi has done a good job in introducing investors to the world of covered call ETFs, because a lot of people didn't know about the existence of these funds back in 2020. However, there's been a situation going on this year with this ETF that needs to be addressed. If you're a shareholder of Jepi like I am, you're likely aware that this ETF has been struggling a lot in terms of share price. Despite the massive rally in the stock market this year, with the S&P 500 currently being up 8.21% in share price, Jepi is still down when looking at share price. According to the charts, this ETF is still down 0.52%. Now, obviously, because Jepi pays much higher dividends, those need to be factored in when looking at a fund's total return. If we use a dividend calculator, we can see that Jepi, with its dividends being reinvested, is up 4% for the year, and the S&P 500 is up higher still at over 9%. These lackluster returns are causing a lot of people, including myself, to wonder if Jepi is still worth holding in our dividend portfolios. Now, I'm not saying that Jepi is a bad investment. It offers a number of really attractive features for people who are drawn to both income investing and growth investing, because it does function in both ways. Jepi has consistently offered a dividend yield of over 8% and it pays monthly. It's also pretty well diversified across different sectors, especially considering it doesn't track an index. When looking at its sector breakdown, it's actually more diversified across sectors than the S&P 500. Jepi's dividends also do not include a lot of return of capital, which is something that some people get concerned about. Plus, it's delivered a positive return since inception, and being a shareholder of Jepi myself, I have made money off of this ETF. But the first main issue I see is that it's been underperforming significantly this year when compared to both the S&P and other covered call funds that exist. Now, like I just said, Jepi does not mirror the S&P, but it holds a lot of S&P 500 stocks. Its largest holdings include companies like Nvidia, Microsoft, Google, and all of those big names. Therefore, I do think it's the best option to compare this ETF to. And because Jepi is a covered call fund, it will always underperform the stocks it writes options on from a share price perspective because of the capped upside. My issue is that I don't really see how Jepi can stand out from other available options that now exist. Back in 2020, when this fund was introduced, we didn't have a lot of choices when it came to covered call funds. We had a number of funds by Global X that were available in 2020. Around that time, we also had NUSI by Nationwide, if you happen to remember that ETF. But there weren't a lot of options available 5 years ago when looking at covered call funds. Now we have NEOS ETFs, we have Roundhill, and we even have Goldman Sachs introducing their own covered call funds among many other companies. There's a number of brand new funds in this category, and when we compare Jepi to a lot of the newer funds that now exist, they've been beating the JP Morgan fund by a large amount with their performance this year. Taking a second look at the S&P 500 in 2025, the market went through a steady decline starting in February and then a lot of tariff drama starting in early April. With Trump later backing down from most of his severe tariffs, the S&P 500 went on to fully recover in share price and has continued to climb higher since late April. Jepi, on the other hand, has been stalling with its share price recovery, basically being left in the dust. If we compare it to other covered call funds that now exist, the underperformance becomes a lot more evident. We'll start with SPYI. We can see this ETF has had faster share price recovery. It was down a lot harder in April, yet despite that, it's now overtaken the JP Morgan fund. These are very close to each other in terms of share price, but remember, Jepi currently yields 8.2% according to their website. SPYI, on the other hand, currently yields 12.15%. That's a 38% bigger dividend. Another consideration is T-SPY, the TAP Alpha SPY Growth and Daily Income ETF. This one is a closer match when looking at share price performance, but again, T-SPY has been much better with share price recovery. Look, at one point T-SPY was down 17.51% in share price, where Jepi was down 11%. Yet the TAP Alpha fund has recovered well enough to be very close to Jepi. and T-SPY comes with a 14.24% distribution yield. The same is true with Jepi by Goldman Sachs. They've released their own covered call funds, and this one in particular is also doing better. It offers a near identical dividend yield, but the share price gains are better. So a question that I think we as investors need to ask is Jepi still a good pick when there are newer funds that have better performance? A second issue that I now have with Jepi is its use of equity-linked notes. My theory is that this is likely the main reason why Jepi, and especially JEPQ, have been lagging behind this year. Both of these two ETFs hold something called ELNs, which are debt investments that don't pay a fixed interest rate. Instead, their returns are linked to the performance of their underlying equity investment. These investments are considered safer because they offer principal protection and are much less volatile than regular stocks. This has to be the reason why Jepi is struggling to make gains this year. These ELNs are providing a steadier share price, and given how fast the market has grown this year, it's caused Jepi to fall much further behind than in previous years. So although this does provide some added safety, there's obviously a huge downside to it. The strategy of holding ELNs should also provide more downside protection when the market is falling, and that is the case with this ETF. But going back to when we compared Jepi to SPY, I'm not convinced that the downside protection is worth it. SPY does fall harder when there are dramatic declines, but the recovery lags significantly more during good times. As a side note, one thing that I've never been a fan of with Jepi or JEPQ is their lack of consistency with their distributions. Before 2025 and this fund's lack of share price performance, this was the worst part of Jepi in my opinion. Although it does pay high dividends every month consistently, they can swing so significantly over the course of a few months. If you're living off dividends, you cannot make either of these two JP Morgan ETFs too large of a percentage of your overall income portfolio unless you're making an extreme amount in dividends each month. It makes budgeting way too difficult if you're relying on either of these two funds. You might collect $1,000 in dividends one month, $700 the next, and then $1,300 after that. Therefore, I could never see Jepi or recommend it as being the foundation of anyone's income portfolio unless you're making like $10,000 a month from it. That's a role that's best suited for an ETF like SPY. I've been saying for years that as time has progressed and covered call funds continue to explode in popularity, that new funds are constantly being introduced that are better than the old ones. It was my reasoning for selling all of my Global X ETFs a few years ago, because we as investors eventually got new funds with better strategies. I think it's clear that when some of the best covered call funds that are now available today were being created, that fund managers took notes from other covered call funds that are already available, like QYLD, and sought to improve their strategies. But for the time being, I'm still holding onto my shares of Jepi as it's still growing in value with the rest of the market. However, at this rate, I'll likely consider replacing it for something new eventually. I don't know what that'll be just yet. It could be a different covered call fund or something entirely different. But let me know your thoughts and if you've been disappointed with Jepi or JEPQ this year. Do you think it's still worth holding on to these two ETFs, or do you think that there are better options that are now available? Let me know what you think in the comments. But with that being said, thank you for watching today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.